This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
F7, December 10. The time is 15:52, so I have 15 minutes to read and 3 hours to do the paper. So let's see what's in the question paper. Question 1, consolidated income, comprehensive income, statement of financial position, 9 and 16. Question 2, comprehensive income statement, changes in equity. Prepare the statement of financial position. But notes are not required. Question 3, is it a cash flow? No, it's not. Analyze and discuss financial performance and position as portrayed by the above financial statements and the additional information provided. Your analysis should be supported by profitability, liquidity and gearing and other appropriate ratios. Up to 10 marks. Alright, question 4. Explain the basis on which the management of an entity must select its accounting policies and distinguish with an example between changes in accounting policies and changes in accounting estimates. Right. And then question 4b, comment on the acceptability of the assistant accountant's suggestions and quantify how they would affect the financial statements if they were implemented under IFRS. 10 marks. And then question 5, explain how the decision to close the furniture making operation should be treated in Manco's financial statements. This looks like a provisions and contingencies question. Okay, well, I'm going to start with question 4, and I'm going to plan on my question paper the sort of things which I think I could bring in to an answer on question 4, certainly 4a. So let's look at question 4a. Explain the basis on which the management of an entity must select its accounting policies and distinguish with an example between changes in policy and changes in accounting estimates. Well, it looks like a question about the framework to me. The basis on which the management of an entity must select its accounting policies. Framework. And policies are for the long term. And surely something from the framework concerning policies is that the accruals or matching concept it should be fairly reflected. Fair presentation is another thing we can bring in. And one of the matters about accounting policies is that they should be selected in order that the financial statements should be reliable and relevant. So I think that could come in substance. I'm just thinking about things from the framework here. Substance over form is another matter which I think I would bring in. With reference to accounting policies, we know that there should be not the possibility or probability that they will need to be changed on the basis that we're looking for consistency within the accounting statements. So explain the basis on which the management must select its accounting policies and distinguish with an example between a change in policy and a change in accounting estimate. Now, it's not unusual for Steve Scott to give in part B to this type of question an actual example itself between a change in policy and a change in estimate. So a quick look down. The directors are disappointed. A major item of plant, it's wearing well, and they're reassessing. Believe that plant is likely to last 8 years in total instead of the 5-year original. So part B, 4b, gives me an actual example, a change in accounting estimate is actually given to us within the question itself in part B, a change in accounting estimate. Plant originally estimated to contribute to profits for 5 years is now re-estimated as 8-year useful life. Now that's a change in estimate. A change in policy should only be effected, or should only be put through, on the basis that it would make the financial statements more relevant and no less reliable, or more reliable and no less relevant. Now there are two other situations when this can happen as well, when the policy can be changed. That is if it's required by a change in law, or it's required by a change in IFRS or IAS. So change in policy, and looking down at part B2, most of the competitors value inventory using ACCA, whereas we use FIFO. Now both of those are acceptable. The assistant accountant has said that the company would improve its profit by adopting the same method as its competitors. A change in policy, change from FIFO to ACCA would be a change in policy, and it's not really an acceptable reason. It's simply to bring in line, is that the expression, by adopting, to adopt the same as competitors. Okay, that would be my plan for question 4. I think I'd also plan, because I think I've still got time, question 5 plan. This is explain how the decision to close the furniture making operation should be treated. Okay, we've been experiencing substantial losses. The furniture making operation is a separate operating segment, so that's possibly then a discontinued operation, which should be a separate operating segment, or substantially the whole, within a geographical or operating area. The company's year end is September, meeting in July, so we've got a year end 30th September. The decision is on the 1st of July. The directors decided to close it down to close next year on the 31st of January, and then dispose of its non-current assets on a piecemeal basis. Affected employees and customers have been informed. Press announcement has been made, so the decision is effectively, can you imagine the reputation of the directors if they changed it? The decision is effectively irreversible, and therefore potentially we're going to have provisions. Okay, the directors have obtained the following information. The factory had a carrying amount of 3.6. It's expected to be sold for 5, so we've got an increase in premises of 1.4, but that's not to be recognised this year. The same date, the plant, I've got a decrease. It has a carrying of 2.8 and net proceeds of 5, so it's looking like we should be impairing the plant by 2.3 million, and that should be done this year. Of the employees affected by the closure, the majority will be made redundant. That's a provision this year. They have been told, we've raised the valid expectation in the minds of those affected of 200,000 redundancy, and the remainder will be a cost of 700,000. Read the question. 750,000 redundancy, and the 200,000 retraining is relating to an ongoing activity, so is not to be provided. This is a cost which should be borne and recognised as it is incurred. Trading losses from July to September. Losses July to September of 600,000 not provided. They will be recognised in this year's figures. But we do have potential losses next year, a further million. So September through to January, there's another 1 million future losses, no provision. These will simply be reflected within next year's figures. We have a possibility of, is it an asset held for sale? And the answer must be no, it's not, because it's not available for immediate sale, and there's not really any need to go on in that area. It's just not an asset held for sale. Is it a discontinued operation? And the answer is no, it's not. It's continuing until January. It will be discontinued next year, and this year's figures will be restated. But it's not a discontinued operation this year. Well, that's given me plans for both Part A and Part B. I've not done the workings for question 4B, the assistant accountant, 8-year life and so on, but I'll need to do those workings obviously when I come to answering the question. Let's see how we're doing for time. It's 16:04 and we started at 52, so that's 12 minutes gone. I've got another 3 minutes. I could actually do some calculations in that 3 minutes, but I think, I don't know, can you see that you can plan a reasonable answer for 4A? It's only 5 marks, question 4A. You can plan that and then write that out in 9 minutes. And same with 4B. Change in accounting estimate is part of 4B. That's an example for the answer to Part A, where it asks for an example. Question 5, I've got the key dates down, and matters which came immediately to my mind about irreversibility, and therefore the potential for requiring provisions. And in fact we do need a provision, don't we? We need a provision for the 750,000. The premise is there's an increase of 1.4 which will not be recognised this year. It's next year, and maybe we don't realise a profit of 1.4 on carrying value. Impairing the plan to 2.3 should be recognised because we've already established from the question that there are indications that the asset is impaired. Losses from July to September not provided. They will be recognised in this year, so it's not a question of a provision, it's just ongoing activities. But the September to January losses, the future losses, is what he's looking for. I think I could put in there also the exception for recognition of future losses. The exception, if there's foreseeable losses from an onerous contract, but that doesn't seem to apply here, so it's not available, it's not applicable. Is it an asset held for sale? No, it's not, because it's not available for immediate sale. It's a price which the directors genuinely expect. It's not being actively marketed, so no, it's not an asset held for sale. Discontinued operation possibly, but no, it's not, because we're told it's going to continue until next January, so it's not even a discontinued operation under IFRS 5. Okay, well, that's my planning time, and that's question 4A and 5 planned. But now I need to get back into doing some mark earning, and I think the invigilator has just told me that I can now start to write my answer.